Good evening. South Africans continue to be in a challenging financial position. The Altron Fintech Household Resilience Index recorded no meaningful change in the last two quarters of 2023, registering at 109.9 in the third quarter from 109.1 in the 3 months before that. Altron says while lower interest rates are on the horizon and will lead to a new growth trend for the index, the lingering effects of the higher debt levels and subdued wage growth will be felt in the first half of this year. And joining us now for more details is Optimum Investment Group's economic advisor, Dr Roelof Botha. Thank you so much for joining us this evening. A little bit of an anxiety-inducing environment that consumers still find themselves in. Perhaps start us off by giving us some details on the index findings and what exactly that means for households.
Yes, perhaps we should start with a relatively good news, and that is the fact that half of the indicators, the Altron Fintech Household Resilience Index consists of 20 different indicators, all of which have a bearing on households' ability to generate revenue, whether that's with their skills or whether that's via their assets, like renting out a second property. And half of them at least are in positive territory. The most important ones here: employment in the private and the public sectors, and your salaries in the public sector. All the indicators are expressed in real terms after adjustment for inflation. But the bad news, unfortunately, is that if one looks at the net effect of the index, although there is year-on-year an increase of 0.3%, which is really not something to have a party about.
Yeah.
Keep the champagne corks where they are. The bad news is that compared to the last comparable quarter before COVID, which is the third quarter of 2019, it's still down by 1.2%. So your average financial disposition of households in South Africa still has not recovered fully from the COVID pandemic, and there is one major reason for this, and that is the Monetary Policy Committee of the Reserve Bank and their hawkish monetary policy.
And just looking at that worst performer in the index, which is that ratio between household disposable income and household debt costs, which came out as one of the worst performers in the index. What exactly does that indicate? And of course, linking again to that restrictive MPC environment.
Well, it's directly related to that. If you look at it from the other side, we express that the indicator usually is debt costs as a percentage of household income, but we use the reciprocal to make all the indicators move in the same direction, whether it's good or whether it's negative or positive. So household debt costs, the percentage of your average household's income that is spent on servicing debt, has moved up to 8.9%. That's one of the highest in the last 3 decades. It went down to in the low 7%. It was manageable until the Reserve Bank started raising interest rates for no particular reason, except they said inflation has increased. But the inflation that we had in South Africa was entirely supply side driven, not on the demand side. There is no demand inflation in this economy. And higher interest rates will not fix global freight shipping costs, which went up over a 2-year period by 700%. And of course, the oil price that until recently went up also by a whopping amount. And those are the two issues that nailed us a little bit on the inflation side. But higher interest rates won't solve this. So their interest rate policy was simply plain wrong.
And now we did hear Dr. Botha from Reserve Bank Governor Lesetja Kganyago at the World Economic Forum, and we did ask him about, when South Africans can expect those interest rates to start dropping. And the consensus is that we should start seeing some relief in the second half of the year. But that doesn't exactly give households immediate relief, does it?
I find this stranger than fiction. Horrible fiction, by the way. Your On the average bond on a home loan administered by Better Bond in South Africa, your average household, your households are paying, homeowners rather, are paying 4,000 Rand a month, every month more, on their loans than they did before the Reserve Bank started with its tax, with this high interest rate, which was absolutely unnecessary. That is an enormous amount of money that could be invested, that could be spent on goods and services with which the economy can grow. I do not know why that they are so restrictive. Our prime overdraft rate before COVID was too high, and it was 10%. Now it's 11.75%. And our unemployment rate has gone up since before COVID. I don't think they are looking at all the data on this economy that they need to look, and they should understand one thing very clearly. The poorest households in South Africa are the ones that suffer the most. They do not have assets, monetary assets which they can invest at money market rates of between 9 and 10%. This really makes me unhappy.
Dr. Botha, will unfortunately have to leave it there, but that horror movie that is still playing out, and we will hear from Governor Lesetja Kganyago next week when they do have that first MPC meeting and announcing the interest rates decision. And of course, that was Dr. Roelof Botha, who is the economic advisor with Optimum Investment